Get cracked. Wake up, motherfucker.
Yo, it is January 29th, 2025. So, Jerome Powell's done. We got through a bunch of earnings, and let me put the earnings on the screen here. So, this is the earnings we're looking at: ASML, CLS, Microsoft, MSFT, Tesla, TSLA, Meta, META, LRCX, Now, ServiceNow, NOW, and IBM. Okay. So far, Microsoft down 4.52% after hours. Tesla up 4.45%. Meta, Facebook, basically Instagram, up 2.27. Lam Research LRCX up 3%. Celestica up 14%. Celestica CLS talked a little bit about it last show. I took note of it because someone mentioned it and it went through my scans. It was one of those big drop companies, those companies that took a big hit on Monday. It recovered pretty much all of that loss. All of that loss because right now up 14%. Yep. It's right back at $114.55. And we have ServiceNow down 8%, NOW down 8%, and IBM up 8.84%. So far, we got overall only one really big, major bad one, Microsoft, but the other ones are taking care of it. I think for now, we can hold our position. So let's look at what we have on the QQQ. So this is where it ended. Mike, yeah, Powell just said nothing new, nothing major, but since the market was already coming in the week in a bad mood, yeah, Jerome Powell probably couldn't do much damage. Like, let's say we were up here, right, on Thursday or Wednesday at the highs of the QQQ. If we came in there and we stayed that high into today, what would have happened? We probably would have dropped. We probably would have dropped. And when you drop at the beginning before a major event, it looks a lot better, right? Because we're up positively. Now, when you do that from the top, you go down to this red, pinkish area here. I think I'm a little bit optimistic for the next week then, as long as Amazon, Google, and who else? One more guy. Well, Apple's gonna do tomorrow. Yeah, I don't know about Apple. We'll have to worry about Apple, Intel too. So tomorrow's Intel and Apple, then Amazon, Google next week. Usually are all always in the same week, or two of them are early last week, but this time around it's most of them are crowded this week and two of them are next week. So not sure, but hopefully the rest will be okay. All right, so let's look at the S&P. So right now QQQ is at 520. S&P, see how that is. Yeah, see, not bad. It's bouncing off of there. So let's see what happens tomorrow. And Bitcoin, during Powell's speech, it bounced back. So it kind of crashed a little bit an hour early when we had, like, I think it was a 7-year bond issuance. So the markets kind of took a little dip before Powell. Then, yeah, same thing with Bitcoin. It followed it. And then now back. So we're above 103.3 case. Yeah, we made everything back here. So if you went long on Monday, yeah, you got everything back. And now you're just waiting to see if this thing can actually make another attempt at 106, 108,000. So if that's true, then I would say next week will be another attempt at making a new high in Bitcoin, NASDAQ, and S&P 500. If that does happen, people will start chasing it all the way up. And I think we'll have to wait for Nvidia earnings, which is later in February. So the market could melt up into mid-February. I think so. Let's see. Yeah, so February 26th will be Nvidia. So it could melt up for another 2 weeks. And then the week of Nvidia, that's when things are going to get bad again. So let's see what happens. Nvidia yesterday, tried to recover quite a bit of it, but it couldn't really do anything when it got close to that 129 area. 129 is where the resistance is for Nvidia, so that's a big problem. And Intel's a pain. So even though ASML is up like 4% in the morning, 4 to 5, yeah, I don't know. I don't know. I don't trust this to really do. But hey, people are already like pretty pessimistic. They got two CEOs right now. So they fired their CEO last year, at the end of last year, and then now you got two CEOs. I don't know. It could be a mess in conference call, but maybe they'll say something good enough that people will just give them the benefit of the doubt, because now we're right back at the bottom of this range, 19.66, where this I drew this line here, which is set all the way back where? Back in COVID or something? No, actually, yeah, before COVID. Yeah, probably back in the 90s. Oh yeah, all right. So 1997, probably the last, and then you had the blow off top of the .com come back, and then you had the great financial crisis. So it kind of, this line has been tested many times around there. So it kind of goes under, over, under, over, under. So this zone 19.66 is where Intel likes to hang out for the past, whew, yeah, freaking 20, 30 years. Yeah, that this is why yeah, Intel stock, I always hated it. And it's probably one of the reasons why I didn't choose to work at Intel, because if I got paid in stock from Intel, yeah, I'd rather work for another company, get stock. Come on, man, because their compensation packages are very weak, and Intel is very infamous for H-1Bs, so they know how to lower your wages, and you have to work in Oregon, so they know they don't have to pay you too much. But when you work in Oregon, you still have to pay income tax, even though it's right on the border, next to Washington State, where Washington State doesn't have an income tax. So if they actually moved their offices in Washington State, I probably would have took it. But oh well, there you go. So anyhow, let's continue on. Intel tomorrow. Apple. Let's see what Apple is. Apple has already been going down into the earnings, but it ignored everything that happened on Monday and went up, up, up all these past 3 days. So I don't know if that's a good sign or not, but it did bounce off of this rising weekly 40 moving average. And you got that blue line I drew here, which is based off of this area, the significant green bar at July. And you see it kind of goes up and down around it. Yeah, so we know this area is important, so it has to hold. So we'll see what happens tomorrow. And after the close, both Apple and Intel are after the close. Let's see what else. I think that's the only important ones I'm looking for. And then on Friday we'll have like oil and gas companies like Chevron, uh, ConocoPhillips. No, I don't think ConocoPhillips does. Exxon, yeah, Exxon and Phillips 66, not ConocoPhillips, Phillips 66. But Apple, Intel, Visa, Cloud. Yeah, okay, yeah. So Apple and Intel, that's the only one I'll care about tomorrow. Yeah, Visa will report, but Visa, I don't think Visa ever does badly. So there's nothing, no news there. Okay, so I'm going to do a quick one today. I'm going to go over an article and try to explain something I noticed last week, which made me pretty bullish. Okay, so this will explain to you why things are bullish. And then first I'll give you the article, which shows you the bearish picture. And then I'll give you the bullish picture that I kind of see. And then you will have to decide what happens. I think they're both correct. And the reason they're both correct is that we will have a bullish move, and then we'll have our bearish move afterwards at the end of February. Okay, if everything works out okay after Apple and Intel reports, and then we go into next week with more optimism, then all you need is Google and Amazon to say nice things, and then we're set. We're set. All right. Good. Good, good, good. Okay, let me present the screen here. Da, da, da. Okay. NYSE line divergence. This was written last week, January 23rd, from McKellen Oscillator. The link is in the description. All right. And we can go here. Let me put some background music. Oh, we got a new one. What's this one? Oh, too subdued. Too subdued. What's this one? The whoopty wop. Oh, this. Yeah, no. The whoopty wop. I'll go back to this one. All right. I'll go back to this one I'm doing. Okay. NYSE AD line divergence. All right. So you see the S&P 500 in the black, the upper black one, right? And the thinner black one at the bottom is what they call the 80 line. And I kind of talked about the 80 line when I did the bond stuff. So I talked about corporate bonds and the 80 line. I forgot if it was like over the weekend or was it the first show I did this week or something. But yeah, you got to go back and look at that one. And I discussed it in relationship to bonds. But this one we're doing with stocks. Okay, so the NYSE daily AD line. All right, so a divergence is when you see the thing moving down, the signal moving down, but the price of the stocks are moving up. So when you see that, you go like, oh, okay, I'm ready for a crash, right? So one time it happened was in 2021 into 2022, right? The end of that. And then we have one happening right now. So that's why we're kind of going like, is this bearish? Is this bearish? Okay, let's see. The S&P 500 on January 23rd, 2025 was able to climb up to a new all-time closing high, but it is not yet dragging along the rest of the market, and this may indicate a problem. This week's chart shows a bearish divergence evident in the NYSE, the New York Stock Exchange, cumulative daily advanced decline line. The divergence is that the S&P 500 is making a higher high, but the NYSE AD line, advanced decline line, right, is not yet confirming. So that's why you see this, you go like, is this going to be something bad that's going to happen or not? That's what we got to watch. Okay, it's not really going to be confirmed until we start crashing again, but we got to be careful. The 80 line is a cumulative running total of the daily difference between advancing and declining issues. Okay, that means the difference of the number of stocks in all of the market. So NYSE is all of the market, okay, except for the NASDAQ, all right? We ignore the NASDAQ right now. The NASDAQ composite index, which has a ton of trash in it. So NYSE is like the more mature side of the stock market. We'll say like how many of those stocks are moving up versus how many are moving down. You take the subtraction of the two and then you add it into a running total. All right. If more stocks are going up, then the 80 line goes higher. Divergences like the current one can be really important, as we saw with the one which developed at the end of 2021. Shown at the left end of the chart above, divergences can also get rehabilitated if the diverging indicator makes up the difference and goes higher. That is possible. So in this case, you see it here happening in around May of last year, and then it went higher. So this signal didn't materialize. Okay, so that's why you have to pay attention. This doesn't predict that it's going to go down necessarily, but it does give you like a sense of warning where like, okay, now you got to pay attention. Okay, this time, if it does start moving down, like next week, for example, like going down crazy, then yeah, jump out. You're done. Dude, we're going a lot lower, very low. Okay, that means no more goofing around, because if you look at the chart, you think, oh, the S&P is just trying to bounce around, going sideways since last like mid-December, last time Powell spoke. Well, that might not happen this time. Okay, this time we go down, we are really going down. All right. Okay. One important point is that a divergence represents a condition and not a signal. That's what I just said. Just because we notice a divergence does not mean that it has to matter right away. When they do matter, it is on their own schedule. The reason why analysts pay so much attention to breadth indicators like the AD line is that most times they do whatever prices do. But sometimes they give a different answer, and that difference can be important. Big cap price indices like the S&P 500 are dominated by a handful of large issues, large market cap stocks basically, whereas the AD line is more egalitarian. Every issue gets an equal vote. When liquidity starts to become a problem, it tends to affect the smaller and weaker issues first. Okay, so that means what's the weaker and smaller issues? Essentially anything that's not Meta, Tesla, Nvidia, Google, Amazon, Apple, Netflix, essentially everybody else, because it's dominated by just 7 stocks right now. Okay, so this is very important to pay attention now that we have a lot of high concentration. They call it a concentration risk. Okay, when liquidity starts to become a problem, right? This is when the smaller and weaker issues get to have problems before eventually coming around to bite the rest of the market. So watching to see what all of the issues are doing as opposed to the currently fashionable large stocks can tell us about the health of the liquidity stream. That is why the NYSE's AD line is one of my favorite indicators to get that message about liquidity. I recommend that people do not follow the Nasdaq's AD line because it has an inherent negative bias. It has never once made a new all-time high and tends to drift lower because of the easier listing standards of the Nasdaq. If a company is going to IPO, then go broke, it is more likely to do that on the Nasdaq, and it will contribute to the declines column every day it goes down from its IPO price to zero. This makes the Nasdaq's AD line unreliable as an indicator, and is currently close to making a new all-time low. It does that a lot. So that's a little side note. So like I said, Nasdaq composite is trash. Now there's the Nasdaq 100, which is why I look at the QQQ. Nasdaq 100 is the best of the Nasdaq, just like the S&P 500 is the best of the total market, 500 stocks. All right. Now, but the NYSE's AD line has worked well for decades, and it still appears to be working well. Right now, it is giving us a bearish warning message. The market is not necessarily obligated to comply with that message, and the bearish message could go away if breadth numbers suddenly start coming in stronger. But for now, it is a big warning of trouble. So what does that mean? Could there be something coming in stronger? Okay, so now that you know what the advanced decline lines are, there is something called the breadth thrust indicator. The breadth thrust indicator is a technical indicator used to ascertain market momentum. It is computed by calculating the number of advancing issues on exchange, such as the New York Stock Exchange, divided by the total number of issues advancing plus declining on it, and generating a 10-day moving average of this percentage. The indicator signals the start of a potential new bull market when it moves from a level of below 40%, indicating oversold market, to a level above 61.5% within any 10-day period. This is a rarely occurring sentiment, which carries tremendous import with market watchers. All right, so and this was developed by Marty Swag, and Swag. I'll read a little not biography, but a little story about him. So yeah, he was pretty famous back in the 80s. Okay. I think that's all you need to know, okay? Because I want to show you this. And this was a tweet made by somebody who was paying attention. And I already noticed this, but I didn't care. But I was surprised someone did notice this. And the link's in the description. You'll see the link in the description. And let me try to explain this one for you. So this one is generated on stock charts. Okay, so as it said, digital indicator that looks at a 10-day exponential moving average of advancing stocks divided by the sum of advancing plus decline. So if you remember, the 80 line is just simply advancing minus decline. This one is a ratio of advancing stocks divided by the sum of advancing plus declines. So if the number of stocks that have went up today divided by the total number of stocks that have moved up and down, okay, not zero, like not flat, then if I take the ratio of those and just make a moving average, add them all up every day, just like advanced decline line, if they start moving up rapidly from some number to another number, and this is, I don't know, he just picked 0.4, so that's 40% to 0.615, 61.5%, and 10 days, I don't know why 10 days, he decides 10 days. If you have that, you'll know that it's a bottom. So this indicator on stock chart somehow like triggered here, 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 and the 2 points, the two ones that he highlighted with the asterisk, the little red asterisk star here, these were the only ones that were valid. The rest of them were not valid. But hey, I'll tell you this. Like, look at the one back in October 2022. You see this? Like, it went from 0.3, so 30%, all the way up close to 0.6%. And that probably was not 10 days. That was, looks like it was about a month, like 3 weeks from there to there. But it's pretty significant. You go from a significant bottom and go to the top. So why couldn't I just adjust this signal and say, hey, that is the bottom? Because for me to wait until April 2023 to buy stocks compared to if I just bought it right here in November, I would have got like probably some of the stocks at a cheaper price in April. I mean, maybe some of those stocks didn't go that high, but hey, I would have missed out on Carvana. What else would I have missed out? Palantir. Like, those were at lows at that time, not April. And so maybe you should adjust the conditions that this signal gets triggered. Maybe the better signal would have been here. You would have allowed for it to be like, okay, it wasn't 10 days. It was 3 weeks. Fine. I'll trigger a signal and buy it here, right? Or at least say like, hey, I'll be paying attention and try to buy it towards New Year's, because we all know New Year's, good time to buy crap stocks that have been going down. Anyway, if we look now, we can see that it's triggered again right here. And this is not a valid signal because it took more than 10 days to go from mid-December all the way up here to mid-January. So that's another month. But it tells me that there was a breadth thrust. Maybe not as strong as what the strict definition of the Zweig breadth thrust is, but still, it's pretty significant, because another time this thing got triggered was in March. So even this one wasn't a breadth thrust that lasted 10 days, right? It took longer 10 days to get up, and this was around March. And this was a good time to buy the bottom of the S&P 500. That was good because it went up again from 5,000 to 5,600. So I'm trying to tell you that we have two signals right now. One signal with the 80 line saying stocks are going to go down badly. Another signal saying like stocks should still be going up. And they probably are both true. We have to go up a lot higher now before we go down a lot more. Maybe that's what's happening. And that's what I've been predicting for a while. Okay, we'll have to see if that's true. I don't know. You can clip this. You can clip this. I made a prediction. I don't like doing this crystal ball shit, but hey, that's what I'm seeing right now with these two conflicting ideas. All right. So yeah, I think the links are in the description for that tweet. You can go read that. Anything else I got to cover? I think the 80 line was already well defined in that article. I don't need to read this Investopedia one. No, I don't think so. And right now, let's go. And oh yeah, you can go to stock charts and look it up yourself. It's called BINYBTD exclamation point. So go to stock charts and you can enter this yourself, and you could go there. Oh man, yeah, yeah, HB, yeah, yeah, clip it, man, clip it. So yeah, and you can use this one, and you'll see, it'll be funny, yeah. Yeah, because John keeps saying like, oh yeah, everything you make a prediction, you got to go, all right, yeah, I got all the predictions from last week. Let's see which ones were right, which ones are wrong. Okay, anyway, cool. Yeah, so you can do this yourself. All right, guys, and maybe one of these days we'll go over it in some more detail. But that's about it. All right. Okay. Let's see. Now, what else? Oh yeah, the story. The story. So this is Marty Zweig. So this guy was a playboy. Okay. Marty Zweig, one cool yacht owner, two bad girls. I haven't read this, so I don't know what the bad girls are, but okay. Wall Street investment guru Marty Zweig forecast the 1987 stock market plunge on a nationally televised financial program days before it happened, but never gloated about it. He was described by friends and colleagues as brilliant, quirky, goofy, and affable, a consummate worrier, and very humble about his stock market acuity. When he appeared on PBS's Wall Street Week with Louis Rukeyser, rest in peace, Louis Rukeyser. Hey, I grew up on that show. That was like that was before CNBC, Bloomberg, all that stuff, man. This you just turn on PBS, that was the guy. One night in October 1987, Zweig seemed hesitant to predict what turned out to be a 23% drop in the market on its next trading day. He didn't grandstand or pound his chest in the style of modern money pundits. Very low key is the way some observers describe his delivery of market wisdom. But the life of Zweig, who died at age 70 in Miami, was anything but low profile in other aspects of his life. He lived large. The financier and his wife, Barbara, bought a 16-room triplex penthouse in Manhattan's Pierre Hotel in 1999 for what was then the most expensive residence in Manhattan, a record $21.5 million. He would later reputedly sell it for multiples of that. To decorate their Tony Fisher Island condo in Miami, Zweig hired a crane to hoist a 1934 yellow Packard convertible into the couple's fifth floor living room. It was a gift from Barbara. He owned an eclectic collection of celebrity memorabilia, including the dress Marilyn Monroe wore when she sang Happy Birthday to President John F. Kennedy. He collected a pair of JFK worn pajamas, suits worn in performance by musical superstars like Jimi Hendrix and the Beatles, Super Bowl rings, Heisman trophies, and Oscar statuettes. The man who began buying stocks as a teenager would later in life donate millions to Miami Beach's Mount Sinai Hospital, where an organ transplant institute was named the Zweig Family Center for Living Donation. And he was a yachtsman. He loved his 187-footer named Bad Girl, after his other bad girl and love of his life, Barbara Ann Deegan. Okay. Bad Girl was found for him by his yacht broker, Jerry Burton of BurtonYachts.com. Wait, that website still exists? I don't know. Okay. And was custom built by Brook Marine in the United Kingdom. And as he would often say, had everything you could want. Bad Girl, like most bad girls, was fast. She hit top speeds approaching 25 knots on her triple MTU water jet engines, decorated with dark wood and creamy accents. It was open, airy, and panoramic. Her decks were expansive. The yacht could sleep 12 guests in 7 cabins, along with 14 crew. It sported a jacuzzi, sauna, dance, yoga studio, gym, water toys, and, in deference to the owner's Yorkshire Terrier, Murphy, a small plot of grass that served as a comfort station. While on board the yacht Hyperion, owned by the legendary Jim Clark, Marty's eyes were fixated less on the yacht than on the original works of art on board by Picasso, Modigliani, and Ledger. In this moment, he turned to his attorney and friend and was heard to say, "Now this is real money." All right. Hope you like that story. Okay, I'll close this up. We got 30 minutes left. Perfect timing. I'm going to play this video here from the Bond King, Gunlock, and he's going to describe what he thinks about what Jerome Powell said today. So let's just hear what he thinks, and we can move on till tomorrow. I'll see you guys tomorrow, and we'll look at that CLS stock, see what it's doing, and we'll look at all the other ones too. See. Yeah, after hours might not mean nothing. When the market opens, things could change quite rapidly. People will sell and buy and go crazy. Who knows? All right. But yeah, Jeffrey Gunlock.
Let's welcome in DoubleLine Capital's CEO, CIO, and founder, Jeffrey Gundlach. It is a CNBC exclusive. Welcome back. It's nice to see you in this new year.
Yeah, good to see you, Scott. Nice to be here again.
You said on social media leading in that this was the most predictable, quote, no change in years meeting. What do you make, though, of what you heard? The market seems to have taken this at least a bit hawkish. Is that your takeaway as well?
Yeah, it's a little on the hawkish side, I think. I mean, the words of this press conference are, you actually nailed it in your intro, Scott. It's no hurry. We're not in any hurry to cut rates. And that's appropriate, I think. We've had a range-bound interest rate market for some time now, and the two-year Treasury is about 4.25% or 4.2%, and the Fed funds rate is at 4 3/8, so they're very much in sync. So I heard a very wide open view of what the next move might be. No hurry to cut rates. Doesn't seem to be there's any inclination to raise rates at this point in time. And he's obviously focused on the stability in the unemployment rate right now in terms of not feeling a need to cut rates. The inflation rate has been drifting higher by a little bit. I mean, the CPI is up in the high twos, and it was down in the mid twos. And with the commodity complex being above its 200-day moving average on the Bloomberg Commodity Index, and looks like it may have bottomed out, and the price of oil is in the low 70s, and Trump wants to get the price of oil down, so he says, drill, baby, drill. But the price of oil hasn't changed very much. It's still somewhat elevated. So what's really fascinating is since the first Fed rate cut back in September, the two-year Treasury yield is up by 60 basis points. The 10-year Treasury yield is up by 85 basis points. The long bond ETF is down on price only, forgetting about the coupon. It's down by about 11%. So we have had this very unusual move that with the Fed beginning a cutting cycle, we have not seen a bond rally. In fact, the general high-quality bond market hasn't made much progress. So I think no hurry, and we're very, very data dependent. It seems like a new high has been reached in data dependency. And I worry a little bit, as I have periodically since the hiking cycle started and now the cutting cycle. I worry that we're running into a high degree of short-termism, that we're going to wait and see what the data does in just a few months ahead is what I think we're looking at. But I think market participants' takeaway from this is the Fed is on hold, and they're just going to wait for data. And so what came out of this meeting was completely expected, and not a lot of insight on where we're headed other than data dependency. And not a lot of insight on where we're headed other than data dependency.
I feel like we might have gotten some insight, if nothing else, into the psyche of the Fed chair when he said policy is, quote, well positioned. I mean, I think he made the case that they think they're in a really good place and they can afford to not be in a hurry, as he said. You agree with that, or do you call that into a little bit of question?
I think when he says we're in a really good place in terms of policy and the economy, he's basically saying we're on hold. And yet, contradicting that, he says we're above the neutral rate. So the implication is that we're on hold until the inflation rate goes down. And unfortunately, it's probably not going to go down very much in the several months ahead. So I wouldn't be looking for rate cuts at the next meeting. Certainly, we didn't expect one in this meeting. And so we have a relatively stable place where we're standing. And it kind of supports the fact that the market is in a calm position right now, and so is Jay Powell, apparently. There are some things that are troubling, though, regarding markets. I notice how high the CAPE ratio is on the S&P 500. It's up in the mid-30s. It's interesting that when Ronald Reagan took office, the CAPE ratio was down at about 10. And so now it's about 4 times higher, or times higher anyway, than it was when Reagan took office. So it doesn't seem there's any room for valuations to expand. And so it's an entirely earnings-driven market. We're going to have to see how that develops. At the same time, the credit markets are very, very low incremental yield versus treasuries. This has been a theme that's been developing now for a year and a half. And there's not a lot of room for error. And in fact, some things have happened, if you get a little bit down in the weeds, that are somewhat disconcerting, because they're reminiscent of what was going on in the mid-00s heading into the global financial crisis about 20 years ago. And that is that we're starting to see retranching of credit risk. You remember, it was the credit ratings that screwed everything up in the subprime market back in 2007 or so. Well, now we're starting to see in the resecuritization markets of bank loans, which is called the CLO market, what we're starting to see is retranching of traditional letter ratings. So, for example, there's triple B rated bonds, and all of a sudden they're retranching them into senior triple Bs and junior triple Bs. Why are they doing that? They're doing that because the average interest rate that's paid by tranching it into two pieces is lower than the interest rate if it was just a triple B. And this is a slippery slope. It's only getting started now. I don't think that it's an imminent problem. One thing I've learned in over 40 years of the investment business is you might be seeing signs that are worth taking note of, but by the time that they really develop into a consequence, it takes much longer than you think. So in the subprime crisis, the retranching stuff and the nutty activity got started up. So I'm not really looking for this to be a problem, in the first half of 2025, but something that bears watching, because once you start making AAA rated securities out of triple B rated securities, which is what actually happened in the subprime nuttiness, that's not happening right now, but it is a slippery slope, something to watch out for. So we're getting more and more concerned about the levels of valuation on the lower tiers of credit. I've talked about this in the past Fed meeting day appearances, but it's getting worse. It's getting more overvalued, and there's these activities of retranching they're dangerous over a multi-quarter time frame. So I think investors need to be upgrading across the board in terms of reducing risk and upgrading across the board based on valuation. And the Fed's on hold, and they're not really in any hurry, as Jay Powell said, to cut. So you're not going to get any relief from interest rates, and you're not going to get any relief from valuation, because valuations on stocks are very, very high versus their own history, and the valuations on non-treasury bonds versus treasury bonds are very, very high based on their own internal history. So this is a time to be careful.
Did think it was interesting that when the chair was asked about financial conditions related to the stock market, he said that asset prices are elevated by many metrics right now. Now, he was, and I think he made the point pretty clearly, that he was zeroed in on parts of tech and the AI related stuff, but maybe not overall. So I understand what you're saying. Last time you were on with me, you said, quote, 2 cuts are on the maximum side for 2025. Given the fact that you believe today was, maybe putting in Sharpie, if you will, that they're on hold for the foreseeable future, 2 cuts, does that still make sense to you for the balance of 2025?
I would say exactly what I said in December, and that is maximum 2 cuts this year. And when I mean maximum, I'm not predicting 2 cuts. I just think that's the most you can possibly think about. And at the present moment, if you had made me pick a number, I would say now 1 cut would be the base case, and maximum 2, though, still.
Isn't that pretty good? I mean, wouldn't that be a good thing if the Fed doesn't have to cut as much as it might have thought initially, and that investors have come to grips with that fact? As Chair Powell said, as I told you what he said about where the economy is and the labor market, he thinks they're in pretty good balance right now.
Yeah, well, the unemployment rate went up for consecutive months, several months. It went up, and now it ticked down. And I think in the most recent reading, and I think he's taking a lot of solace from that movement. He was worried about the labor market weakening, and so the Fed's goals were in something of a tension. I mean, the CPI, or the year-over-year inflation rate, which he referenced today, that you use year-over-year. I thought that was important. He mentioned that it takes out some of the noise of seasonality. But it's a departure from where we were 18 months ago when we were talking about annualizing short-term inflation numbers. So he's looking more at year-over-year inflation. I do think that the unemployment rate being at 4.1 and having relaxed a little bit, I think that unless the unemployment rate starts going up, there's going to be a very it's going to be a slow process to get to a hurdle to cut rates again. And as I said just a few minutes ago, I don't think that you're going to see a cut at the next Fed meeting. So when the Fed says we're in a good place, he means the policy he believes, or he chooses to believe, that it's going to lead to the unemployment rate staying at a comfortable level, a relatively low level, and the inflation rate, he's hoping that it comes down. I don't really understand. They mention owner's equivalent rent or the shelter component, and yes, that should come down. I don't know how much Southern California is going to factor into that because there's obviously not going to be home price declines for new construction or for rentals and so forth in Southern California. But I think it is good that the Fed's on hold, and it's because you need the Fed to be on hold or being easing to.
Oh, Kimmy, yeah, Qubit. Yeah, I talked about Qubit from time to time over the streams, but I don't play that one. For me, it's like something you can day trade. Like trying to hold it over a few days to me sounds really risky. So, yeah, you can play it for maybe a couple more weeks, but you're, oh man. I mean, had I known like all that quantum computing stuff would get hyped up last a quarter, I would have recommended it strongly. Only if you bought it near the bottom, because Qubit, QUBT, and all the other stocks went up after IONQ already started moving up in September. So QUBT and all the other ones, they just moved up because Trump got elected. All right. So IONQ was the catalyst for it. IONQ moved up in September because it had a huge contract from the government. And then once Trump got elected, like everything just got juiced, right? Everything in the stock market got juiced. So QUBT is like a small cap stock, micro cap, basically. It's easy to pump those stocks, but it's easy to pump, then it's easy to dump too. So that's why, yeah, I wouldn't touch it unless you're just day trading it. Yeah, it's fine day trading. Yeah, I see the chart. You could just like wake up in the morning, see what it's doing, and then go like, all right, I'll buy now, and then wait for a few hours and you get out. Something like that. Yeah, you could do that, but otherwise, nah, I ain't playing that. I ain't playing that. So anyway, yeah, the quantum computing. Yeah, Marcus Shkreli's been trying to short that thing forever. He probably thought he was okay a couple weeks ago when all those quantum computing stocks dumped on Nvidia CEO Jensen Huang's like little comment. So all those quantum computing stocks crashed like 20 to 30% in one day, and then they slowly went back up, and then once you got to like January 13th, the whole stock market was moving up. Then everything just recovered, right? So it's just like, come on. So he's stuck again. So I think when the market moves up in the coming couple weeks, if we survive Apple and Intel tomorrow and into next week with Google and Amazon, yeah, QUBT, sure, they probably can just keep zooming. But I think they'll have earnings eventually, so you can try. I'll look at them again, but I didn't see them move too much. There's a lot of better opportunities out there, like you see like the nuclear plays, and yeah, I'll have to cover those tomorrow. The nuclear ones that got hit in Monday, and then CLS got heavily hit. So that's a semiconductor one that got punished a lot for some reason. So right now it had earnings after 14%. It was up 14% after hours. So it recovered everything. It dropped 25% on Monday, and it recovered everything all the way back in after hours right now. So after 2 days of moving up and then after hours combined, yeah. So there's a lot of other opportunities that you can get something quick, but for now it's gonna be rough. I wouldn't touch anything. If you're an investor type, someone that just wants to buy and don't look at something, it's better to wait from March to April. Yeah. Because right, so I said like last year when Powell was like killing everything in December, I said, okay, that means we're gonna go sideways for the next month. So January's been all sideways, right? We're back to the top for the S&P, and now everyone's kind of wondering, are we going to go up or down from here? And I think we're going to go up after what I've seen today. We're going to go up again next week, and then probably another week. So 2 more weeks. And then the third week of February, watch out. And then the fourth week of February, NVIDIA earnings. So that's when things get really shaky because we'll probably make a nice new high. People are very optimistic again. They forgot all about DeepSeek in China. See, people's memories are like goldfish. Like they forget quickly, like the news cycle. Once the news cycle shifts again, first the news cycle is like 500 billion, Stargate. Then the next news cycle, oh crap, China DeepSeek kills all of AI and nuclear energy. And then the next week it's going to be something else. So it's like, so it's great for trading, yeah, but it's terrible for investing. All these guys that are investing are screaming on Twitter. They're like, "Oh man, market's idiocy. There's too stupid market, irrational, blah." Dude, everything's irrational. Doesn't matter. So, and you hear this guy talking, right? Jeffrey Gunlock, the bond king. He's always a downer. He's always like stocks are overvalued, man. And now he's even saying bonds are overvalued, like corporate bonds are overvalued. It's just like, come on, dude. You've been saying there's a crash coming around the corner for like a couple years now. So that's why, dude, don't listen to anybody. Don't listen to anybody. Just accept the fact that markets are stupid and just try to make money with dumb retardation. Okay. Yes. 12th man, what's up? Yeah, Jewel. Yeah, you can watch it tomorrow. Yeah, you can rewind it and watch it. All right, let's continue. Let's continue with the downer, sour mood here.
Support the valuation levels that we have.
Jeffrey, I'll bring you back in. In terms of inflation, it was the chair who said, quote, "We seem to be set up for further progress." And in fact, recent reads on inflation were more calming. I think we could agree. Do you think we've seen the peak in the backup in rates that we witnessed from the cut that we sat together on, the very first one, that jumbo cut? Then rates backed up. We both sort of looked at the screen and we're like, whoa, that's interesting. And they continued their march, certainly the 10-year towards 5%. It felt like it was going to get there, but then they backed off of late. Had rates peaked?
I think that rates have not peaked on the long end. I think rates will have another move up on the long end. It is interesting that the chair says, that we've cut rates by 100 basis points, and that's true on the Fed funds rate. But the 10-year Treasury rate is up by 80 basis points since that first cut. So mortgage rates, which price off the 10-year Treasury, had relaxed a little bit, and so housing got a little bit of improvement. But rates are back up to about 7% on 30-year mortgages. And I think the longer they stay at that level, up to about 7% on 30-year mortgages. And I think the longer they stay at that level, the shock of, people remember the 3% mortgage rates, and then all of a sudden they were 7%, and that's kind of a shock. But now they've been up at 7 for around 7 for really a year and a half. And so, but I think that the budget deficit problem is primarily responsible, I think, for this backup in long rates. Even though the Fed's cutting interest rates, this is by far the worst performance of the 10-year during a Fed cutting cycle. Usually bonds rally when the Fed starts cutting rates, but that didn't happen at all. In fact, rates went up. So I think that inflation is not going to easily go back down to 2%. We're well above 2%. I mean, we're at 2.9 on the core CPI, and or 2.6 or 2.7 on the headline. I mean, we got to get below 2.5, I think, to talk about putting rate cuts back on the table. And Chair Powell was quite clear in stating that we don't need to see a 2.00 inflation number, and I think he uses the PCE primarily, but we don't need to see 2% to talk about cutting rates. It's almost like it's the direction of the CPI, and right now the direction of CPI is sideways, and he needs it to start coming down. I see that the owner's equivalent rent can filter through. There is merit to that idea, but I don't really see it from the commodity complex. And we'll see what happens with tariffs. So there's a lot of uncertainty, and for that reason, I think we're only 6 days or 8 days, whatever it is, into the administration. For that reason, I think the Fed being on hold, corroborated with the Fed funds rate, totally corroborated by the 2-year Treasury. It's appropriate the Fed's on hold, and so this was a inconsequential meeting versus expectations. A little bit of hawkishness with that no hurry language, but he was a good three-handed economist. On the one hand, on the other hand, on the other hand, and it's a wait-and-see situation.
Given your view of the deficit and certainly the longer end of the yield curve, is that why is it a fact that you still like intermediate dated bonds, nothing longer than the 10-year like you told me before?
Yeah, we still believe that the yield curve continues to steepen. Irregularly, of course, but we were negative 108. The 2-year Treasury was 108 basis points above the 10-year back in last summer. And now it's at 34 basis points positive. We've had a huge swing on that, and I think it has a lot to do with supply problems. And I don't believe that the deficit is going to improve under the Trump administration. You can find, $50 million here and $6 million there through something called, the Doge thing, or the Dog E, as I call it. But I don't think you're with looking at some tax cuts and forever spending on wars and natural disasters and all this stuff. I don't think the deficit's going to go down under Trump, and that's going to be a problem with the Fed on hold. And now the bonds that were rolling off from 5 years ago with coupons of 0.5% or 1%, it looks like they're going to be solidly in the 4.25% to maybe 5.25% range when those bonds roll over, and there's a lot of them coming up. So the long end, I would continue to avoid it. I like the intermediate part of the market. It's not nearly as attractive as it was 18 months ago. Spreads are much tighter on credit products. The Treasury rates are lower than 18 months ago. But when you take a look at the inflation rate, even if it's at 2.5% to 3%, you have a real rate of return from fixed income. I think you should always have a real rate of return from fixed income. We've lived through so many years of repression of interest rates that we had zero or negative interest rates versus the inflation rate for a long time. We should always have a term premium in bonds, and we have one now. So bonds aren't all that risky, but I do think that under the fiscal situation that we'll likely see another move up in the 10-year Treasury yield.
Everybody, obviously, you, me, every investor, the Fed chair himself, as he made it clear today, trying to figure out what the impact on the economy and inflation tariffs are going to have. The proposed Commerce Secretary, Jeffrey, Howard Lutnick, said today on Capitol Hill that it's, quote, nonsense that tariffs are inflationary. What do you think?
Well, he's got an example to point to. It's a sample set of one, but the last time the tariffs came through, we did not have an inflation problem. Back under the first Trump administration, there were tariffs, and inflation did not stir whatsoever. So I'm open-minded on the idea that tariffs do not have to have an inflationary impact. But first, we have to see what the tariffs are going to look like. And there's an awful lot of saber rattling going on with the tariffs. If you do something that the president doesn't like, it's instantly tariff talk. And I don't know, I don't think that's really healthy as a one-tool reaction to all policy programs. If you have a hammer, every problem looks like a nail. And if you're a tariff guy and you're going to respond to policies of foreign countries that you don't like, and you're just constantly going to tariffs, I don't know. I think the effect of that will incrementally wear off. But we'll wait and see what the tariffs look like, and they need not be inflationary.
You have argued against the renewal of the tax cuts. I've asked you about that on several occasions. You've been pretty unwavering on that. Is that still your view today?
Yes, I want the budget deficit to shrink, and you're not going to do that by more tax cuts. So I don't really like the SALT thing in the tax cuts. I think it's really kind of absurd that was put on way back in the first Trump administration. That one I'd like to see go away, but otherwise the tax cuts, I don't want to see tax cuts. I want to see spending cuts. And I don't know if we're going to get that. Certainly history has not given you confidence that talk of reducing spending was going to result in a reality of cutting spending. But we shall see. Trump was a deficit spender in his first term, and I don't see any indications that that's going to change. And that's why I caution against high risk positions right now, because I think long-term interest rates can go up, and valuations, as I said at the outset, are very high on credit in the bond market and on obviously parts of the equity market. So I'm favoring, again, equal weighted equity exposure rather than market weighted. That seems to have started to work. And I think fading the trends of growth versus value and small cap versus large cap, equal weighted versus market weighted, I think those got very extended during 2024. And I would not want to be betting on just a momentum trade that continues. So I like equal weighted in the S&P. I continue to like cash because Fed's not going to cut rates. Bonds on the shorter end to intermediate range, the price off of Fed on hold will continue to deliver. You can get 6% fairly easily. It's not going to make you rich, but it's a real rate of return of more than 3%. And I think you can live to fight another day when you get cheaper valuations in both stocks and credit bonds.
On that note,
Man, what a downer. This guy is such a downer. All right. When I end this video, yeah, I'm gonna show you one chart to explain what he says about the deficit and all that. Okay.
has what I like to refer to as the Gundlach model portfolio changed in any way? You like cash. You said last time 30% cash, 50% short-term bonds, 20% in U.S. stocks. That still sound right given what we know today?
That's about right. I might change something, in 05 here or there, but broadly speaking, that's the right parameter. About half money in relatively, middle credit to upper credit bonds in the shorter, to the 5-year area, 3-year area of the yield curve. I don't like stocks at these valuations, and I would still maintain maybe some of that cash you might want to hold in a real asset, perhaps a commodity fund, which seems to be showing signs of life. And gold, I think, has another move high as well, although it is near the all-time highs. But I still think dollar cost averaging into gold makes sense in this uncertain geopolitical environment.
Sure. Before I let you go, Jeffrey, I know, and we've talked before, and I could see from some of your social media posts that you're out in the Palisades,
Right.
and it's really hard to comprehend those pictures, especially 3,000 miles away here in New York for many. I just wanted to say, wish you well, everybody out there, our hearts with everybody. Just a terrible situation that's going to take a long time to recover from.
It's much worse than anybody realizes in terms of the disorganization. There's nobody in charge. There was no preparation, and nobody knows what rebuilding is supposed to look like or how it's going to be organized. But I was spared. I was evacuated for 3 weeks, but I was able to get back this week, and I had some damage to my property, but fortunately my house inside is completely intact. If you go through the neighborhood, it truly does look like the pictures you saw of Dresden from World War II. And all that's left in most houses is a bunch of powder on the ground and a chimney, and the chimneys are evocative of a tombstone, and there's an awful lot of them, thousands and thousands of them. It's absolutely brutal to go through the neighborhood, and it's not going to be a short period of time. It's going to be years and years before this gets to some level of stability and livability. So thank you for the thoughts, and lots of.
All right. That's too downerish for me. He's a downer. Anyway, yeah, that's interesting, huh? They're gonna do the tokenized treasuries. I wonder what's gonna happen with that. That would be pretty cool. So yeah, we gotta tokenize John Galt's properties too, right? John Galt coin. So I got somebody's gonna have to start this up, and we could have a REIT. You could have a real estate investment trust using John Galt coins. I just gotta figure out which platform, which tokens to use. I was Solana, but I might go somewhere else. The SUI coin, which is made by the Facebook engineers, that looks more promising nowadays. Yeah, technology changes too fast, though. I'm just not young, I just can't keep up with this stuff, especially with the AI changing so quickly now too, with the Chinese and all that. Just like everyone's screaming and yelling, hooting, hollering, and they're looking through the code and trying to figure out what they did. And I'm like, oh God, if I was 20 years younger, yeah, this probably be slick. So I've been watching some YouTubers do the AI stuff. It's just like, wow, man, this is It's pretty cool. But yeah, I'm too old for this game. Anyway, this chart is the 10-year yield. That's what he was talking about, the bond yield. So since the 80s, we've been going down in a trend here. Down, down, down. Interest rates have gone down, down, down. And the COVID was the last time we had really low interest rates. But in general, the trend is down. And now we've broken it. So now the trend is going up. So what's this other line I have here? This maroon line, I guess, or red, magenta line, depending on your screen. This line shows you the percentage of debt versus GDP for the United States. So back in the 60s, right, 60s and 70s, we were around 40 to 30% of our GDP was debt. Now, our debt has grown since those times into the 90s, and since the great financial crisis, even more. We were actually 100%. So the debt is actually 100% of our GDP. So, so at that time, and then now after COVID, we are 120%. Yeah. So the debt to the GDP is 120%. So our debt is greater than our GDP right now. All right. Well, so that's why he's a downer. He's a downer. He's basically saying, hey, the interest rates are going up. How is the government supposed to pay on that interest if the debt is now greater than the GDP? So eventually, this will affect us. Eventually, yeah, the chickens will come home to roost. But like I said, the markets are irrational. They don't care. They just care about what's affecting things day to day, week to week right now. Yes, this will be a problem. Maybe in 10 years. Yes, this will blow up and bite us. I doubt anybody, any president, any government can change this. You got Medicare, you got Social Security. That's why, I don't believe in Social Security. And even Medicare and Medicaid stuff, I don't even know if I'll get that. Move to Taiwan. Taiwan has a very good medical system, and so you don't need insurance. You can just go into a Taiwan hospital, get a number, and wait, and they'll call your number, and you go in, and you'll see a doctor, a surgeon right away. So, so I knew someone. I met someone in COVID in San Francisco because everything was locked down. I met this Taiwanese dude, and I mentioned this story before. So he was a photographer, artist type guy, and he lived in Taiwan. He had an apartment condo there, and so he went back. So he sold his place in San Francisco and went back. But yeah, he was telling me all this stuff like Thailand and Taiwan. They have very good medical systems. They speak English. So you can go there, and you don't need insurance, and it'll still be way cheaper. The problem I have with the medical insurance here is like you pay a lot of like premiums, but you get nothing when you actually have trouble. Like you got the copay and all this crap, but over there it's like you don't have to pay insurance. And the American dollar is so much stronger than the currencies in Asia. You can go there, your dollar goes further, and you can get like Western level healthcare at a cheaper rate. So a lot of this like medical tours, and that's why a lot of like people go to Mexico for dentistry, because they actually have a city in Mexico called Molar City. Molar City. That's a nickname for, I don't know what the Mexicans city is actually called, but yeah, it's Molar City. You could just fly over there, get an appointment, get your like implants, or if you got serious medical dental issues, you could get it way cheaper over there and be done with it. So all of that city is full of dentists, like the most dentists per capita. So they call it medical tourism, right? Yeah. So crazy world we live in. So I think a lot of this stuff is because of inefficiencies in the system. So you can't really say, socialism, capitalism, this and that. There's just overall like discontinuities. There's something up, right? We have too much inefficiency, and you just got to get rid of the fat. right? The bureaucracy, probably a lot of hospitals are just filled with bureaucrats. Everybody, like the pharmaceutical companies, are like pressing down, and then all this other crap. Oh, Jesus, crazy. It's just too much. We got to streamline the system completely. So it won't be solved with like rhetoric. Like you say, oh, universal health care or this and that. None of that's going to solve anything. There's a fundamental issue here that has to be resolved. All right, guys, you can see where we're headed. A lot of debt coming our way. I don't think that's going to come down. We already screwed up with the great financial. We bailed out the banks. You see, you bailed out the banks, and you already got right up to 100% of GDP is debt, right? So our debt is basically 100% of our GDP now, and it's just going to get worse. So every time the government has to pay back its debt at 4 whatever percent, and because Yellen, when the interest rate was low, Yellen did not issue a lot of bonds that could take advantage of this low debt. She didn't issue a lot of 30-year bonds at near 0%. If the government issued a ton of bonds, then we might have been okay. But they were afraid, I think, that if they issued way too many bonds, the Saudis and Japanese and Chinese did not want to buy them. So the reason we could survive this long with so much debt is because foreigners love buying our debt. But as you can tell, the Chinese don't really love us anymore. Japan has its own thing where it's like, hey, we got to raise our interest rates, and they probably don't care if their economy is going to get better. Yeah, they probably won't care about like buying more debt from us either. And the Saudis also now are getting stronger in influence around the world, so they are kind of looking at us kind of skeptically, right? Ever since Russia, what happened to Russia, the Saudis definitely look at us like, yeah. So interesting times. Yeah. So, and the Europeans also will. They have their own issues. They're not going to buy our debt either. So not many people are willing to buy our debt unless you find aliens. If you find some aliens in outer space willing to buy U.S. bonds, hey, that's great. But I think this is why Yellen decided not to do that, and now Trump is going to have to figure out what to do now with his new Treasury Secretary. So I'm going to be curious. In February, they are going to announce how they're going to do their bonds. Okay, so. Alrighty, guys. I'll see ya tomorrow. This 1 hour stream later.